Hi, welcome to the Crypto Experts. Today, we'll dive deep into why banks may no longer be the best option for your financial needs. Although banks have been a driving force in the modern economy, their traditional operations are challenged by cryptocurrency's emergence. So let's get started and explore why banks may be a thing of the past. So you know how everybody's been talking about blockchain technology lately. It's gained a ton of attention in the past decade, making its way into conversations among banking experts and investors. But there's still some doubt whether this tech will completely overthrow the traditional banking system or make some big changes. Banks have been very critical of cryptocurrencies lately. So what's the deal? Are banks becoming useless now? You can take that as a big fat maybe. Cryptocurrencies like Bitcoin and Ether work on public blockchains where you don't need any middlemen to verify your transactions, which makes it super fast, cheap, and borderless. Sometimes Bitcoin transactions can take up to a few hours or days to settle, but it's a game changer compared to the 3-day processing time for bank transfers. Plus, crypto transactions are decentralized and complex, which makes it challenging for governments and regulators to keep tabs on them. But no worries, developers constantly look for ways to make crypto transactions even cheaper and faster. Bitcoin Cash and Tron can get you low-price transactions with averages of less than 1 penny. And thanks to blockchain tech, micropayments are doable. Check out Satoshi Pay, a crypto wallet that lets you pay tiny amounts to access paid content and supports payments in Bitcoin, US dollars, and more. With traditional lending, it's all about your credit score, right? But with blockchain technology, the game is changing. You could be looking at things like peer-to-peer loans in a faster, more secure loan process. Banks usually calculate loan risk by checking your credit score, debt-to-income ratios, and whether you own a home, all provided by major credit agencies. But this centralized system can mess over consumers and put sensitive information at risk. Meanwhile, blockchain technology provides a more efficient, secure, and inclusive alternative to traditional personal loans. See, instead of relying on a credit score, blockchain enables loans based on a global credit score from a decentralized registry of payment history. Companies like Salt Lending are totally on board with this. They offer loans against blockchain assets by determining loan approval based on collateral value, not credit score. Banks do way more than just clear transactions and process payments. They've also got to onboard customers, check their identities, and make sure all their info is straight. This process is called Know Your Customer, or KYC. Banks can spend up to 3 months handling all the KYC proceedings. Blockchain tech can cut down all the human effort and money involved in KYC compliance. How? By keeping all that KYC customer info stored on the blockchain. The decentralized nature of the platform lets all different institutions that require KYC access that info. Banks can also use blockchain tech to beef up their fraud and cyber attack detection game. Keeping all that customer info decentralized makes it way harder for hackers to swoop in and grab all that sensitive data simultaneously. Blockchain smart contracts make online transactions safer by ensuring each process step happens before the next one starts. Platforms like Bloom let users create blockchain profiles and keep an eye out for any identity leaks. Another cool project is Quadrata, a blockchain KYC solution that lets users store compliance and KYC AML info on a non-transferable NFT, like a digital passport. Today's financial markets are a bit of a maze. You've got brokers, exchanges, and banks trying to keep tabs on who owns what. The whole setup still hanging onto old-school paper systems that are slow, can mess up, and even open doors for scams. Want to buy stocks? Good luck doing that electronically without a hitch. You need custodian banks to handle your shares. But since buyers and sellers don't always use the same banks, you end up with third parties holding the paper certificates. This means ownership transfer is a mess because everyone's got their version of the truth in separate ledgers. Luckily, blockchain technology could revolutionize financial markets with its decentralized database for unique digital assets. It allows asset rights transfer via cryptographic tokens representing off-chain assets. While Bitcoin and Ethereum have done this with digital assets, new firms aim to tokenize real-world assets like stocks, real estate, and gold. This could disrupt the US's 4 largest custody banks. Blockchain could eliminate mediators like custodian banks, reducing asset exchange fees. Tokenized securities through blockchain can function as programmable equity via smart contracts, enabling actions like dividend payouts or stock buybacks with simple code. Several blockchain companies aim to transfer trillions of financial securities to the blockchain, such as Polymath, which launched its Polymesh network in 2021, involving 14 regulated entities as node operators, and later added investment firm GreenTrail and digital asset exchange Huobi. Getting venture capital cash is no picnic. You're talking decks, endless meetings, and haggling over equity and valuation, all for a slice of your company. But some folks are skipping all that and raising money through initial coin offerings on blockchains like Ethereum and Bitcoin, selling tokens straight to the public. It was all roses until 2018 when the ICO bubble popped, funding took a nosedive, and regulators started sniffing around. So it's not all smooth sailing there either. Many tech companies are getting hip to this decentralization stuff and using ICOs, mostly for blockchain projects that aren't making money yet. There's this company called CoinList that's playing middleman, making sure ICOs for blockchain companies are all above board. In 2021, CoinList had a whopping $1 billion monthly trading volume. And they're not the only ones in this game. You've got Waves Republic. Co and others are all diving into this ICO world and exploring blockchain tech that might just give traditional banks a run for their money. Did you know a bank transfer can take up to 3 days to settle? They have to deal with a complicated web of intermediaries like correspondent banks and custodial services. It is not as easy as just sending and receiving money. Balancing and reconciling occur across traders, asset managers, funds, etc. And if you're transferring money internationally, everything has to go through SWIFT. If UniCredit Banca and Wells Fargo don't have an existing financial connection, they've got to hunt for a correspondent bank in the SWIFT network to settle the transaction. But of course, there's a fee involved. The SWIFT protocol is only responsible for sending payment orders, not moving funds. And to make things even more complicated, a bunch of intermediaries has to jump in and handle the money, which can add cost and create some potential for errors. However, blockchain technology could be a game changer in traditional banking. Instead of relying on SWIFT for reconciliation, an interbank blockchain can record and settle transactions without needing those go-between services. Say goodbye to those days-long processes of conventional banking systems. This fresh approach could potentially knock down the high cost of global correspondent banks. Ripple has already cooked up some cool blockchain stuff for banks, helping them clear and settle transactions. They figured out a way to chat directly with a bank's records, making messaging and settling up happen in real time. International trade is a big deal, but trade finance is often stuck in the Stone Age with its old-school manual processes. That's where blockchain tech comes in. It could streamline trade finance and save us billions. With blockchain, you get a secure digital proof of transaction details that boosts trust and visibility for exporters and importers. This kind of innovation addresses long-standing logistical problems caused by outdated documentation processes. Blockchain technology could transform trade finance by enabling tokenized payments upon delivery of receipt of goods. Smart contracts could automate payments, reducing the chance of errors or fraud. This technology could also enhance the traceability of goods for buyers. Banks like Standard Chartered and HSBC are part of initiatives like Voltron, a blockchain platform that digitized letters of credit, reducing processing times from 5 to 10 days to less than 24 hours. So disruption isn't a snap of a fingers kind of a thing. And there's a lot about blockchain tech that still needs to be ironed out or put through the ringer. Some folks are convinced that blockchain and cryptos will replace banks. Others recon blockchain will give traditional finance a facelift, making it more efficient. How much banks will cozy up to this tech is still in the air. But one thing's certain, blockchain will shake things up big time. This was the Crypto Experts. What are your thoughts about banks? Comment then down below. Until the next video,